All right, welcome back, everybody. On today's Squawk Planner, the Fed kicking off a two-day policy meeting. They're going to be watching closely at 8:30 a.m. Eastern time today. That's when we get the latest consumer price index data. Read on inflation, very important. We're going to wonder what they see here. Expectations from economists are that it will be 3.1% last time around. That holds about steady on a month-to-month basis. On an annual basis, economists are looking for that increase of 3.1% after last month's gain of 3.2%. Joining us right now to talk about this and the Fed's interpretation, what it will all mean, is Constance Hunter. She is senior advisor at MacroPolicy Perspectives. On equities this morning, we've got John Mowrey. He is CIO and senior portfolio manager at NFJ Investment Group. And welcome to both of you.
Thank you.
Constance, let's talk through the CPI number first. This is a big deal, and we are thinking that the Fed is on pause. The market is taking that a step further and even thinking that they're going to be cutting rates sooner rather than later. How big is this number, and what are the implications for what we see today?
Well, I would say there's a step between pause and cut, and it's a step called hold. And in that hold step is linked to their higher for longer, right? This number is going to be important, but I want to preface that by saying we think that there is going to be a bumpy road down to 2%. So while we are expecting a softer headline number at 0.1, there's room for surprises here, and on both on the upside and the downside. And we shouldn't over-index to one number. What the Fed is probably going to be looking at is a 6-month annualized pace. And so they're not going to move rates until we get to a 6-month annualized pace that's closer to 2%.
That's very sound and probably the right way of looking at things. The problem may be that the market is telling us that they think they're going to cut sooner. So the market is reading into far more than the Fed is saying at this point.
And that makes sense because the market is forward-looking. The Fed can't be quite that forward-looking. They will come closer together. Our own view is that they start cutting in May and then they cut 6 times next year.
Yeah.
We're going to get to a point where they're going to need to engineer a positive sloping yield curve. And that is going to allow more bank lending to be done. It's going to open up some engines of growth in the economy, which, quite frankly, are slowing down. If you look at the last jobs report, it was very narrow, right? 3 sectors accounted for 98% of the jobs growth for the last 6 months.
I think the risk, though, in the markets, John, is markets are bidding this up. You've got yields that have come down. You've got equities that have moved up as a result. And if there's a hotter than anticipated number, that could put everybody on pause.
It could, but I think one of the big things that we've been pressing with our investors is if you look at the spread between the Fed funds rate and the 2-year yield, that is quite wide. And what's fascinating is the 2-year yield over the last 1 year is up just 20 basis points, okay? But the Fed funds rate is up 225 basis points. That spread historically is very wide, and you can graph this going back all the way to the 80s. And if you do that, every time the Fed funds rate is elevated above the 2-year yield, they end up cutting. And you're seeing that spread very wide today. So if you were to look at the historical means, you would say roughly 100 basis points would need to come out to get closer. So the market's been anticipating this. By the way, the 2-year yield was well ahead of the Fed on the way up. So that 2-year yield is the market. I think that's important.
When you've looked at this historically, what is the duration? I mean, what is the timing issue? Meaning how quickly?
Usually 6 to 12 months.
It's been within 6 to 12 months every time.
Every time they do this, within 6 to 12 months, they end up cutting. So I think the market's been looking.
Cutting the full amount?
Cutting by, well, okay, I'll give you an example. In 2000, okay, the Fed raised 3 times 100 basis points total. And then in January of 01, 1 month later, they cut twice and pulled 100 basis points out. So there's not a ton of observations, right? But what we can see is that they can be forced to act very quickly. And if they knew they were going to cut in January of 01, why would they have raised 3 times in January?
Right. Which gets us back to the question of how quickly this economy is actually slowing. Do you like what you're seeing right now, Constance? Do you get concerned?
Well, I would say we started the year in the soft landing camp, and we have grown increasingly concerned, right? Because the tailwinds have started to mount for the economy. We have a slow global growth situation. We don't have China as a growth engine. We have this inverted yield curve. There are a lot of headwinds to growth. We're seeing, as I said earlier, we're seeing jobs growth really narrow, and that is a big concern. And then if you come off holiday spending has been weaker. We think the consumer is starting to weaken. And so we are definitely concerned. We think that there will be much slower growth in the first half of next year, but then we think the Fed will begin cutting. But I mean, if we go back to 2018, right? They weren't going to cut. They were on a hiking path. And then we got to 2019, and of course they had to cut. Sure. So when the data starts to reveal that we're in a much weaker situation, which it is already starting to do, I think you're going to see them move.